Let's see how jumpy our next guest is. Well, it matters because he oversees $2 trillion of assets at one of the world's largest money managers. Lacaille is Global Chief Investment Officer at State Street Global Advisors. Rick, thank you so much for coming in.
Morning.
There is a lot of market jitters out there because actually we don't exactly know what will happen to inflation because of rising oil prices and what will happen to interest rates. What are you focusing on right now? Are you more concerned now than you were just 2 weeks ago?
Yeah, a little bit more concerned, but in a way it vindicates a long-term investment strategy where you have a very wide range of assets. So, for example, putting commodities in a portfolio, putting a little bit of high yield, putting real estate in a portfolio makes sense because you can ride out the bumps much more effectively when you've got these other assets that are coming into their own at times like this.
What happens if the unrest spreads? We were just hearing some breaking news from the Saudi king saying that he's going to extend subsidies to a lot of the inhabitants to try and keep protests at bay. But what if it does spread to someone like Saudi Arabia?
Yeah, I think two things happen. One is the VIX continues to get higher because people will demand more of a premium for the risk they're taking. And secondly, a longer-term effect is people reflect on the potential effect on the oil supply as opposed to the price. So the price has gone up, which is a short-term impact. Unlikely to feed through to inflation unless it's persistently high. But in the longer term, the question is about supply and whether the supply-demand dynamics have significantly changed. Now, in the short term, not the case, but in the medium term, if you had a substantial change in the Middle East, then it could affect the balance and that would have a longer-term effect. And I think that there would be a more justified impact on equity markets then. And
Rick, what kind of impact will it have in Europe? Because we've gone through a debt crisis. We're hearing that, the Eurozone is ready to act in terms of a bigger package, but at the same time, we have Mr. Trichet saying, guys, I'm worried about inflation.
Well, yeah, setting aside whether Mr. Trichet is worried about inflation, Europe is a mixed bag from an equity perspective and from an economic perspective. You've got the core countries growing very rapidly. It's not all about exports to emerging markets, but clearly that's an important part of it. Whilst the periphery is struggling to some extent to overcome this sovereign crisis. But from a valuation perspective, I think European equities look reasonable. Yields are high, earnings yields look reasonable value in many sectors.
Would you be buying any of the peripheral bonds? I had two investors actually telling me that they were looking into Angel Gurria of the OECD. Well, he's not a really investor, but PIMCO was also saying actually it looks more attractive now.
Well, maybe, but I think there are better ways to deploy risk. The issue with the periphery is really a binary sort of bet. It's a binary bet with a very strong political dimension. And whilst on balance, we think the periphery will work out its issues in a way that's going to work out reasonably well from a bond investment perspective. The lack of visibility is less attractive than some of the other positions where you can take risk in fixed income.
Such as?
Well, I think credit risk taken where you've got a greater degree of visibility, particularly in corporate credit, high yield. In investment grade, I think a lot of the value's been squeezed out. And in fact, high yield spreads have declined substantially. Nevertheless, we still are a little overweight in high yield.
Rick, talk to me. You were saying that actually what this shows, the unrest in North Africa, is how important is it to have a very diversified portfolio. Talk me through your ideal portfolio. How much corporate bonds would you have in there as opposed to cash? Because it is still very volatile. Yeah,
we've been very low on cash. Well, I guess there's two questions. There's a tactical question and a longer-term question. For long-term portfolios with a time horizon that suggests you've got some risk tolerance, then cash will be very low in a portfolio. And we put investment-grade bonds in there at 10, 15%, or maybe more if clients are more cautious, in order to balance out some of the other risks in the portfolio. But the really diversifying assets are things like commodities, commodity trading, or other sort of hedge funds that offer a very strong payoff when you have turbulent markets such as now.
What about, it might sound like a crazy idea, but why not invest in some of these markets where there is little liquidity, such as North Africa? I'm thinking of Egypt, because, well, once the risk goes away, you may get a quick buck.
I think it depends on your tolerance for lack of liquidity. I think the problem we had in the last 3 or 4 years was that people thought they had a high tolerance for lack of liquidity, but that turned out not to be the case, and liquidity changed very dramatically in some asset classes. So I think you can earn the liquidity premium. I think you'd be earning other premia right now in North Africa, but I think you'd have to be very careful about committing too much, given that those are markets where things could change very rapidly.
I know it's very difficult and there's so many moving parts, but is there one thing that you're looking at in terms of unrest that will make you more confident about the world economy in general? Is it when Gaddafi steps down? Is it when the markets open in Egypt?
I think we have to focus on things that are not affected so much by unrest. It's an inherently unpredictable and binary outcome that you're seeing in many of the parts of the Middle East. But there are many other places you can invest that really are not very sensitive to that. And in particular, equities in the US, emerging market equities to some extent, where we've got still some degree of overweighting, and high yield. Yes, they'll get affected because the risk premium changes, but from a fundamental cash flow perspective, there's less risk there.
What about inflation across the world? Is affecting, of course, Europe, the Middle East, but also the Asian economies, such as China. Is this a concern?
Well, in the market already, I think it'd be hard to say it's not a concern, because you're already seeing visible signs both of inflation and central bank action to take action against inflation. We'd be more concerned if there was no action taken and you had both a credit bubble and an uncontrolled rise in prices, which would cause social problems.
Rick, will the game change once interest rates start rising across the world? And who do you expect to move first, ECB or the Bank of England?
Well, of course, long rates have started to rise already in anticipation of this short rate action. The Bank of England will clearly be split to a large extent. I think they're probably right to hold rates as they are, because there's many other factors going on in the economy that might change expectations of inflation, particularly the austerity measures. I think the ECB faces a more difficult challenge in many respects because of the sovereign debt crisis, and trying to balance perhaps a looser monetary policy together with a little bit of acceptance of restructuring and some degree of fiscal help for the periphery is probably the right balance. So I would think on balance that the ECB might have a little bit of a looser policy.